Hello and welcome back to Game of Trades, your #1 channel for videos on the stock market and cryptocurrencies. The stock market has been stalling at resistance here for the past few weeks. This big level of resistance at 4,200 that marked the bottom in March of 2022, the top in May of 2022, the top in February of 2023, and now we're at that same level of resistance, and also a big significant price channel resistance. We've explained in prior videos and prior Twitter threads why this is such an important channel, connecting the two most extreme points of the bear market, using that as a reference parallel line, connecting that to the all-time high. That is where we currently stand, just under that resistance level. I'm going to show you evidence that is beginning to stack up for the idea that the stock market is likely to fail here at this resistance level. Keep in mind, I could be completely wrong on this. Ultimately, the market is always right. And if we do break out here, that is a significant change in the technical structure of the S&P 500. By the way, don't forget to smash the subscribe button if you are new here, and click on the like button down below if you enjoy this episode. It is very much appreciated. It makes the effort that we put into making these videos for you guys worthwhile, so that is very much appreciated. By the way, there's only a few days left to take advantage of the deal that we're currently doing on our website. We're giving 1 month of free access to everything that we have on our service, our model portfolio, our videos, our tactical updates, our watch list where we cover all the assets, all the trades that we have. We also have lots of new features that are coming up on the service. So if you want to test it out, make sure to click the link down below, go to the website, start your free trial, and you'll automatically start 1 month of free access. Now, let me begin by pointing out that the volatility index of the S&P 500 is low right now. It's hovering around 15 to 17, and that is the same level that we saw here in 2021. So for everybody that says that there's a huge amount of fear in the market right now, that investors are currently in panic mode, that's completely false. You look at the all-time high in 2021 right here. You look at this big top in 2021 here. Volatility was at the same level as where we are now. So for me, right off the bat, this doesn't point to the fact that there's a huge runway for stocks. Of course, you can have volatility stay very low for extended periods of time as the market grinds higher, but ultimately, big tops in the market occur when volatility is low. 2019, 2018 here, even 2017 here, all big tops in the market occur when volatility is low. If you're a trader and you want to put the odds on your side, you want to be buying stocks when investors are really panicking, and that is when volatility is elevated. So should we expect volatility to rise here as we see a rejection off this big level of resistance, both in terms of horizontal resistance and also price channel resistance? I think we should. If we take a look at initial claims, more recently we saw a big surge in the number of people filing for unemployment. Now, initial claims, you can consider that one of the more leading indicators of unemployment, right? If we zoom out, I put up the unemployment rate on top of this chart, we can clearly see that initial claims quite often lead the unemployment rate higher, right? Here in February 2000, you had initial claims surge in the months here leading up to November 2000, big surge in initial claims, while the unemployment rate was still very low, and ultimately the unemployment rate followed, right? Same thing, for example, in 1990 here, you can see initial claims clearly climbing very aggressively here until January 1990, while the unemployment rate stays low. So we are in this phase that is similar to maybe January of 1990 to August of 2000. And if you want to go further back in time, you can also see these moments here. They don't last very long, right? And this is why this is a near-term signal, because you can see initial claims rising here in 1981, right before the unemployment rate actually begins to rise. So the unemployment number really only takes into account these rising initial claims, a few months later. Same thing here in 1973. Initial claims begin rising as the unemployment rate is still falling. That's where we are now. In August of 1973, in June of 1981, in January of 1990, in November of 2000. And if we take a look at what the S&P 500 does following these instances, you can see here September 1973, that was right before a significant bear market. Same thing in 1981, before a significant bear market. January 1990, that was at the top of a bull run before a small bear market. The 1990 bear market was very shallow because earnings didn't contract that much. And the Federal Reserve was able to ease monetary policy very significantly here during that recession, which really propped up market valuations. And you can see October of 2000. So we are at that moment where initial claims are rising, but it's not yet being reflected across the board on unemployment numbers. And if that continues, if this is really a signal that the labor market is weakening substantially, that's bearish for the market. There's no doubt about it. It is bearish for the market. So either you're in the camp that this is an anomaly, that we're not heading into a recession, that this is actually going to turn back down and we're going to continue seeing a strong labor market for the foreseeable future, at least for the next 6 to 12 months. And so in that scenario, you could actually imagine a stock market that goes up as long as inflation comes back down, which, by the way, if the labor market is strong, it's unlikely that you'll see inflation come down very swiftly and that the Fed will just be able to ease monetary policy, because the labor market is one of the big indicators that they actually look at when it comes to monetary policy. So they are waiting for a big weakening ahead of us. So either this is your opinion, we're not heading into a recession yet, this is just a temporary weakness in initial claims, or you're of the opinion that this is the real deal, that the unemployment rate is going to begin rising. And so in that scenario, stocks have more downside to go, right? And I can show you the VIX so that you have a better idea of what's happening here. The VIX, the volatility index of the S&P 500, that goes up when the market is going down and goes down when the market is trending higher. You can see the VIX volatility rises when the labor market is weakening substantially, right? You can see here 2000 volatility remains very elevated as you have a weakening labor market. 1990, same thing, volatility rises as you have a weakening labor market. Same thing during COVID here. So you can see clearly right now we have a divergence between initial claims that are rising more aggressively than at any point that we've seen since 2020 or 2008, and volatility is moving down very aggressively. If you look at moments that are similar to that, we have this moment here where volatility was moving down while unemployment was rising here in around May 2008 here. Initial claims rising, volatility moving down. And you had the same thing here in July of 2000 and the same thing here in June of 2001, volatility moving down while initial claims are rising, volatility moving down when initial claims are rising. This resolves to the upside in terms of volatility rising to the upside. That's why we do have a short-term bearish view on the market and not a nuanced view of, well, the market could go higher in the near term, but ultimately it's going down. No, we are clearly pessimistic on the market right now because we're seeing our thesis of a recession playing out as we speak, but the market is disregarding it. So we think that's a discrepancy, and discrepancies don't typically last very long. Now, something else that does tell me volatility could be set to rise and that we're seeing a complacent market right now, if we add the volatility of the S&P 500 here against the US dollar, this is the US dollar currency index, the DXY, the DXY. You can see over the last year, it's been extremely correlated to the volatility of the S&P 500. So as the dollar moves higher aggressively, well, you see volatility spike. So the market moving down, same thing as you see the dollar moving lower, you have the volatility moving down. And that is simply due to a mechanical relationship, because as the dollar rises, it puts pressure on corporate earnings. A big portion of the S&P 500 revenue comes from abroad. And so when you have a stronger dollar and that revenue is measured in dollars, well, that revenue that comes from abroad diminishes in value. And so it makes the earnings look worse. And so it pushes the S&P 500 down mechanically. And that's what's been happening over the last year. Now you can see more recently, we've had the dollar move higher here. We've had the dollar break out of this short-term consolidation, short-term wedge pattern. We have a nice breakout. Now it's retracing some of that as I'm making this video, but you can see volatility hasn't broken out. Volatility is still hovering near its lows, and the S&P 500 is still at resistance. So, we'll see where this move on the dollar is headed, but this is another signal that the market right now is disregarding. So we have the dollar moving higher, which has been typically bad for the stock market, while volatility remains low. Now, keep in mind this relationship can change, and we do think it's going to change. It doesn't always work like this. Volatility can rise when the dollar is moving down and vice versa. In fact, you can see we briefly saw that here during the banking crisis in March of 2023. You can see here the dollar moving down in the first half of March here. This moved down here, and the volatility index of the S&P is spiking. During a recession, you can have periods of time when the dollar is moving down and volatility is spiking. And that's actually something that we expect throughout the rest of the year, is as we head into a recession, the VIX moves down and volatility spikes. But right now, as we speak, this relationship remains intact. So until further notice, a rising dollar is bad for stocks, and we've had a bounce on the dollar here. As a quick example of what type of market environment can give you a weak dollar and a lot of volatility, we saw that very clearly here in 2002. You can see here very, very weak dollar, waterfall sell-off in the dollar, and yet the VIX here was spiking as the market was moving lower during that recession. So the odds are stacking up against the stock market's ability to break out here. And that's not just because we have a bearish 6 to 12 month view on the S&P 500, because we think we're heading into a recession. We see the S&P 500 at resistance right now. We see a lot of macro driving factors that suggest there is a significant risk of downside here. But of course, that's just our opinion. Anything can happen. The market could break out here. In fact, I do think there's a lot of people betting on downside here with stop losses parked just above this big resistance level. So could you see a false breakout and then a resumption of the bear market? It's possible. But ultimately, we do think right now there are sectors that are very interesting to short here. There are defensive assets that are very interesting to own right now. These are all things that we cover on our macro strategy at gameoftrades.net. So make sure to take advantage of that deal that we talked about at the beginning of this video. Now, in the meantime, I wish you good luck on your trading and see you next time.